Hey everybody, what's up? It's Booksy. Today is January 10th, 2023. I'm going to be doing a demo and a model for you, this particular kind of pattern that we've seen lately. And really this video kind of encapsulates everything over the last several weeks that we've sort of learned. And it's a good thing because at the end of the day, this would not be purposeful. You wouldn't have a point for this unless you had what? Unless you had a way to derive price targets from this kind of a pattern. The good news is the price targeting for this pattern is very, very reliable. It's very consistent, and ultimately it gives you a really good idea of what to expect going into one of these patterns. And ultimately, it complements really well what we've just been talking about with creek crosses and S-curves and beaks and all these other things. If you haven't recently seen a lot of the macro videos, I would suggest you watch them. They're kind of long. Some of them are longer than others. They address different things. Some of them address the S-curve. Some of them address the what I call the master fractal sequence, which is very much at play here. And then others are a little more like nuanced, like I kind of talk about like just little things that we're kind of learning, stuff like that. Today I'm going to be focusing on the diamond that's within the curve, and there's something really interesting that's going on in how it's setting up for drops. Now, I know that from a layman's perspective, what you're going to be looking at when you look at something like this price action where it comes up and it creates basically a hook and drops, you're really just looking at what? A giant, fake out, breakout kind of thing where it looks like it's going to create a huge bull. This one in particular is a very, very dynamic, long bull structure that most people, including some professional analysts at the time, thought would continue, meaning they estimated another 10 to 20 weeks of upside based on the way in which this thing was going. It was a massive structure and then it broke down. What we've discussed recently is that the very nature of the S-curve is that you have two competing trends, and one of them is bullish, right? So it's an arc that's heading upward, that's going back to retest some area that you broke down from, and I'm going to make an argument that it's most likely going to be this particular hook right here, the previous supply. And then there's a downward trend, right? Which of course, is bearish. And that downward trend would represent what essentially what the bears are up to. And it's not just like supply and demand. Obviously, that's a big part of it. It's a lot of it, though, is who's in control of the stock. You don't see this kind of deep liquidity S-curve without a need for either liquid or without, in this case, since it's downward, an operator who's trying to drive the price pretty low. In this case, I think they're going towards that 786 level, and we'll get to that in a minute. But the big thing here is that what this does is it generates what we visually see as an S-curve. And we've talked about this at length recently, that your S-curves, essentially all they are is a basoning, right, that turns into what? A basoning that turns into a downward motion, and it creates just a sine wave to the downside. Main reason this is significant is because we're particularly interested in sine waves here. We want to see what happens to the sine waves as they pertain to the master fractal. I'm not going to pull that up right now, but it's important to note that the master fractal sequence is a shrinking sine wave, okay? It's a shrinking sine wave. I have that in multiple videos. I did a whole thing on the master fractal sequence recently. Again, highly advise you check it out if you haven't and you really want to understand the actual sequencing that's going on here and how it pertains to where we are. The big discovery that happened yesterday goes back quite a ways, and that's why I've got the chart pulled up as I do here. If you recall, we did a diamond bottom analysis way back, and I had a video about it and everything, and we came up with two price targets from that analysis. The first price target that we derived from that analysis was the major price target, which is the normal one. If you go on to any kind of a diamond bottom schematic, the height of the diamond bottom, basically that largest double flush that occurs, And that should be your breakout target once you finally leave. And you'll note that this target in particular, when you go to where it should be going, in this case, it's $29. And if you were to drive back, you can see that, okay, that's a previous, it actually goes right up to the previous little diamond over here, which is kind of fascinating. But it's basically the same as the previous target on this diamond, which is interesting, or at least one of the previous targets on this diamond, I should say. That was a long time ago, and obviously we never hit that price target. So that was always kind of a curiosity, like why would it present itself that way and then not hit it? Diamond bottoms have a 73% chance. It's very high, and Bukowski does a sample size of like 300 plus. So this is not like a small sample size for statistics. He does a lot when he samples these, and 300 plus is a lot of samples. So when he says something like, hey, this hits 73% of the time, that's highly reliable. Highly reliable. That's one of the most reliable patterns that exists. So why then did it not hit its pattern? Why did it come back down? Well, look, there's a number of other things at play here. The first being, of course, that you're in a downtrend, in a bearish market situation. And that might be the easiest thing for a lot of people to understand. Like, look, yeah, this could be a diamond bottom Booksy, but it also could just be a bouncing down, right? So maybe you didn't get it quite right, all right? Maybe you didn't get it quite right. But here's the thing. When we were back in this region studying this particular diamond bottom, we noticed that there were some really interesting things that happened. So number one was the offset value. These are just a quick recap, just to remind you. The offset value, meaning like the amount that this diamond pushes down here from its liquid center, not from its bottom, but from its liquid center, the original liquid center, which is where the intersection is of these two trends, down to the bottom, ends up equaling the offset value that occurs, right, from where the drop down to the next top is. So they're using math, right, to shift the chart lower and to achieve, a certain price on the rebound. In addition to that, and this was kind of the biggest one that we need to talk about today, there was another target that we derived, and that target comes from basically like, where did the breakdown happen? I'm going to have to make sure I draw it right. Often forget where it was over here. The breakdown, meaning like, where did we leave and then retest? It's basically right here. And if you take a value from that particular point to where the structure of the diamond begins, and I'm going to make this green so you can see it better. And you take that structure and you look at where does the diamond begin, meaning like, where's the liquid center? And you take that and you measure it down to the place of breakout. You find that it's equivalent basically to the penny of the exit move. Now, that in and of itself may not be conclusive evidence for you, and I understand that, but it's one of the main reasons why I got almost a to the penny price target for the move in August. And all I did was I measured from the hook, again, very similar structure, right? Measured from the hook, you may recall this. And this is very important. This is why I'm talking about it. I wouldn't be talking about it if it wasn't important. This is important for what we're talking about today. And then you notice that if you measure that to the breakout point, it's exactly correct. And it's not like it has to be to the penny either. Obviously, at the time, I think I was so nervous about it that I said it was probably a range between 25 and 27, $2 range. But even saying that, that was exceeding what the downtrend most people were drawing was, at least on the logarithmic chart. So it seemed like that was a little like weird, right? And I even thought, well, that's kind of strange, but that should be the first target. What I didn't anticipate, of course, is that the rest of it would just continue to come downward. And again, that has a lot more to do with this beaking formation, right? The beak that's coming down, the bearish curve, the S curve that's forming, than it does anything else. And it is formed, right? So this is a super important concept to understand for what we're about to talk about. And here's what I basically think is going on, is that you have an entry to the diamond. So I'm going to look at this little structure over here. So you have a breakdown from some supply, all right, some support rather, and it becomes like a supply, and you drop down, you have a sell-off. You enter your diamond, and then when you break out of your diamond, you're getting basically an equivalent move to the upside. That makes sense. Why not go all the way up though, like you did over here? Well, again, it has to do with, I think, where we were in the schematic at the time and the fact that we were about to form an S-curve. This does have a bit of an S-curve to it, but it's very flat. It's very horizontal, whereas this is going downward. And there's a significant difference there, and that's really what I'm trying to explore today, is that difference in how a downward moving, falling diamond bottom that's within a beak, how you could possibly measure that and get consistent values on the downside for those bounces, if that's something that you're interested in. Well, here we go. Right. Looking at this very first structure, you're kind of looking at it thinking, well, you know, to some degree, we're just kind of swooping down and creating like a new bottom here. We know that the liquidity that's grabbed over this 11-month period or whatever it was is very high. And then as you continue forward, we've been talking about how we believe that these are all essentially the same. They're all a bunch of shrinking iterations coming downward. And this is one of the things we talked about in the most recent video, was the nature of, and the dynamic nature, rather, of this falling bottom here, and that we're seeing it start to create a sine wave that's getting smaller and smaller and smaller as it goes downward. And it's ultimately, it looks like the beak is pointing towards, the beaking part of the S, rather, is pointing towards that 255 area, which is the 786. It's very, very similar schematic-wise to what you see in 2020 leading into 2021. But what is it about this structure that needs to be said today? Okay. Recently, we've been talking a lot about the this particular beak structure here and how it relates to the S-curve, these cross lines, things like that. I'll talk about that really briefly, but here's what I think is the main takeaway from this. So if I'm going to tell you like, hey, here's where I think you can kind of find your own way in this, and if you really don't understand what I'm about to talk about, this is going to give you like a loose version of it. It's not exactly correct. Like there's some nuances here, but it's essentially like what's going on. So if the price action is as follows, right? You're coming down. I'm just going to do an arrow. You're coming down. You're breaking down from a previous support. Then the swooping motion, as it were. Here, let me use the other thing. The swooping motion, as it were, would be, the purpose of that would be to get you to a liquid target where you're going to accumulate for a time. That's this region right here, liquid level target. Once you cross the creek, which is established at the top, usually by the cat ear, all right, usually by this cat ear formation, for instance, right here, it's these two. Then you break out, you have a run to the upside, usually going to check the previous liquidity target, right, which again was established in much the same way, and then you start it all over again. When you come back down, you're going back down to retest the creek that you crossed, but because the creek in this particular instance is so steep, you're coming lower, so by nature, you're going to be breaking down beneath the liquid target level that you just established, so it creates that hook effect. And then once again, you're doing it again. You're creating a new liquid target level here, you're breaking across a creek, and then you're coming down again, and then rinse, repeat. This particular pattern, as we see it, creates a sine wave that is shrinking, diminishing, and it's not only doing that, but it's also coming in a downward parabolic arc. So it's unlike something like a wedge, which is linear. This is parabolic. It's increasing every time, and therefore it's not just traveling like less distance, less distance, less distance or something. It's actually going downward more. So the angle at which it's descending is increasing, and therefore you're getting a parabolic move, okay? That's, I think, the basics of what we're talking about here. It's just establishing liquid levels, checking the previous levels, going through the liquid level you established, breaking down, right? Establishing liquid levels, checking liquid levels, going back down. Some people would look at this and say, this is the automatic retest. That's not always the case, though, because from a technical standpoint, the moment that you break down here, a lot of times you're going to have an automatic retest. So it's important to like note that that's not really like necessarily the best way to technically describe it, because you could have an automatic retest almost immediately, right? And then as a result, this check on the previous liquid target is not always exactly what you think it's going to be. And the big kicker here is that what we've realized is that this arc that's created, the bullish arc that's created, is really the target most of the time. So sometimes you're going to come back and check that liquid level, but if you've got that arc targeted correctly, that arc is typically what's hit, not like a horizontal, which is pretty complex, right? It might sound really difficult, but the truth is that if you do it right and if you have your schematics drawn correctly, it should be pretty easy to tell where those are. So for example, in our current time frame, if you're looking at this schematic, you're looking at the bullish arcs, right? You can tell that, yeah, it's a very clean hit on, I'm drawing it kind of weird here. This actually should go out farther. Oh, you get the idea, okay? But this comes up and it doesn't stop at where you think that liquid level might be exactly. It kind of comes up beyond it. And the reason for that is, of course, is coming to that arc. It's not just coming to the liquid level. So it's important, again, to note that as this is happening, it's not quite as simple as, oh, it's doing a liquid level target, because that would make you believe that it's always going to be a really simple, like, oh, it's the lowest point, for instance, like here. It could be this lowest point at 515. It could be, but it could also be a higher point at like 560, right? And that would mislead you into thinking that you had broken out, which, not surprisingly, is pretty much exactly what happened here, which is that they had brought it up to a place so high that it basically was starting to make higher highs within this range, and it was looking like it was in the middle of the range here. If you go back and just observe, like, come back to here, way back in time, and look at where we were, it looked to us, and yeah, we did come to that, original bottom way back there, but it does look to us like, hey man, that looks like it's breaking out. Like, it's way above where we were down here at 596. It looks like it's getting ready to SOS, so on and so forth. All right. The point being that as you see this thing develop, you should start seeing it do the same thing over and over again, where each time it's creating that kind of that arc that you're going to see manifest in a retest of the previous arc. And so essentially what's happening, and I'm going to get rid of these for just a minute, but essentially what's happening is that every time, and this is going to talk about these red lines, the 50% cross lines, okay? Every time you're crossing a creek here, all right? Every time you're crossing a creek here. So what I'm going to do is I'm going to be shuffling some lines around. I'm going to be getting rid of some stuff, and then I'll add it back in later. All right? I'm not going to get rid of the diamond just yet. Yeah, actually, I'll get rid of these. And then I'll make this brighter so you can see it. One of the rules that we've been talking about recently is this 50% cross line. And what this is basically like the moment that you cross over the creek, and usually, again, it's like a cat ear line from like way back here. All right. The moment that you cross over the creek, there's usually a quick retest and then you go, and that's where your bigger explosive move comes from. If you take a measurement from top to bottom here, rough measurement, right, and you look at where that intersection is, it's roughly 50%. It's not always exactly 50%. And it's important that you use both the cat ears and your judgment based on what you're seeing here to determine where that actually is. What we're finding, though, and this is the best part about it, is that this gives you an idea of where you're going to go next. Because remember, when you cross this creek, right, this is a price resistance. When you cross this price resistance and you push over top, when you come back to retest, you're usually going to come right back to that creek to retest. And sure enough, this is what we find is happening consistently in these downtrends, is that every time you're going down, you're crossing that creek and you're retesting. Well, you'll notice that, of course, every time it's laying up, it's doing the same thing here. So once again, here's that arcing downtrend, right? When you break out here, you're testing the previous creek. It looks like a falling wedge, of course. You've got an arc being established, a bullish arc being established. The direction of the price wants to go back up to where? Probably back to the top that it broke down from. In this case, there's interpretation of it being at like 1060 and then maybe way up here. I think it's more likely like that 1060 area. But it's going back, like it's wanting to go back and retest that area. Just like here, it'd want to go back and retest the breakdown at like 21, right? It's arcing in a way that's trying to reach back up. Bulls are like, well, yeah, we want to go back and test that liquid level. They don't get it. Same thing here. You don't get to the place you want to get to. What you do get is you do get a rejection off of the previous arc. And then as a result, you get knocked back down and you start it all over again. Okay? In our present time frame, there are a lot of different kind of cat ear schematic looking things that you can do. One of them is very, very wide. It's like way out here. Another one is pretty narrow. And that's the one that I'm kind of favoring right now, which is one that roughly goes through here. And I think we just crossed it yesterday going into today. And you can see that there's a pretty clear price resistance there, right? That's being met repeatedly, and now it's sort of breaking out of it. So each of these rising accumulations here that's happening are essentially like the same fractals. They're just being used in a different way. One of the things, though, that I didn't really ever think about, and this is kind of where the revelation came from yesterday, was, hey, man, if you're looking at this thing, and this is the rising accumulation, what do you make of all the other stuff that's going on? Well, not a whole lot, right? This is kind of just like you start breaking it down into different chunks, but you don't really include the rest of it in that. And what I found yesterday by comparing it to SPY looked really asymmetrical in some ways compared to what we're seeing on AMC. On AMC, if you look at AMC's current bottom area, which is right here, there's a bounce, a big upthrust, and then another bounce. There's a symmetrical place to that, but it's not left to right. It's way high in the schematic. It's way up here in the schematic. And that's this area right here. And this is the basic shape that we're talking about right there. And that same shape, there's a bounce, a big upthrust, and then another bounce. That same shape does appear right down here on the bottom. And then what happens in the middle is really an upthrust and a downthrust. It's like an extreme moment of volatility, right? Where you're basically doing what I think, if you kind of glance at it, looks like a giant rotation where you have a double check on the top and then a double bounce on the bottom. And all of that is doing what? It's just positioning you on a lower target down here. Okay? It's part of the breakdown. Well, that's great, Booksy. And you can see that, that the whole structure is made up of the same thing as well, like the bounce, the upthrust, the other bounce. But what is that? Because that doesn't look very familiar to us. It doesn't really look like something we've experienced before. Usually, in our schematics that we have, that we use, you're seeing something that doesn't quite have the same, let's call it highs and lows. Usually what you're seeing is something like that, where you have, you might have the M top that kind of looks like a bounce, right? But then the bridge typically is like a very low riding thing, and occasionally it comes up, higher, but then it ends up forming like that, and you end up with a giant M, blah, 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 blah. And every now and then you get a big, movement in the middle that will test perhaps like it's like almost like a giant automatic reaction, right? That might occur in the center, but that's pretty much it. So what is this that doesn't kind of vibe the same way? Well, I'm going to make the argument that it's actually the same schematic, and that the nature of it is essentially just a diamond. Because the more that you start studying these things, and the more you start observing how they're using these to manipulate the stock and to kind of quickly accumulate, and in this case, do an accumulation schematic on the downside, right? The more you start seeing that, the more you can start recognizing it for what it is. And one of the big giveaways is that when you enter the diamond structure, all right, you start the diamond usually with a narrowing, right? So there's a drop in and it's very narrow, and then it gets wider, and then you get narrower. Yeah. So I said I wasn't going to bring up the schematic, but I may have to do that so that you can see it, because it's very important that you are able to visually see what I'm talking about. We talk about the narrowing, right? And how that's essentially shrinking, where they're combing through the range, right? And you're shrinking. And that would be this guy right here, okay? And that it starts with a widening. It starts with a big widening of the range, big push down, push back up. And then from that point forward, it starts narrowing. Well, when you start looking at it from that point of view, specifically like, in this region, you can see that it's really not all that different from what we would come to expect in our schematics. Like that looks like a cat ear with a little paw. It looks pretty much just like what you see over in this region. There's a narrowing that's occurring, right? Right here, as it's bouncing to the outside. This is the narrowing that's occurring. So there's a widening that's occurring in the beginning, and it's followed by a narrowing. That is the diamond schematic, right? So our whole accumulation schematic is based on this idea of widening to define the range and then narrowing in on the areas that you want to accumulate. Now, how would that apply, though, to a downtrend? Well, that's the kicker, right? Because we've sort of tried our best to figure out like how you would get those targets, and the only one that seems to work really well is that initial target, the target which is, in our case, is being used to get us, on just the breakout, not all the way up to the full diamond bottom target, which should be the breadth of this entire thing. It's not working that way, right? It's not working that way. And that's unusual because, again, this is a 73% target thing. Target statistic, which is very high. So take into consideration that during the accumulation, you're widening and you're narrowing. During a diamond bottom, you're widening and you're narrowing. So during this structure, we're just talking about it right now, you're widening out and then you're narrowing in. And then when you get to the end, right, you are breaking out and leaving. And what that kind of tells me, and the more I started staring at this, comparing it to SPY, it's a weird schematic, yeah. But what it tells me is that they're creating a downward accumulation on weakness, which of course, to some degree makes sense because we know that that's kind of what they've been doing anyways. Why OBV can rise even though the stock price is falling, because as they're coming into these bottoms, you're getting a high amount of accumulation as you go sideways into the bottom because it's running a full schematic within this diamond bottom structure. This is why this is such a huge deal, and this is kind of like the finishing touches on the video. Basically, what this is doing right here is kind of common sense. I don't think anyone would look at this and say this is anything brand new. But the idea here is that what they're doing on, I'm going to move this to the side, what they're doing on a sequential scale is as they're dropping you in, they're forming the full sequence to accumulate this range. And then when they break out, you're getting an equivalent move at the same angle at which you enter, which is a big deal. So if you enter at 109 degrees, you're exiting at 109 degrees. Oopsie. Point in case here. You can see that the entry of this angle, I think in this case it actually matches. It's like pretty much a dead-on match. But 61 degrees, right, as the crow flies. And then here you've got another 61 degree angle. And it gives you your target. So there's a methodology then that if you're coming into this range, if you can identify where that diamond is, where it begins and it ends, and you know where you broke down from, then you should be able to very easily come in here, triangulate. All right, here's where I'm going to be when I break out, because we have a price target and we have let me change color somehow. We have a price target and we have an angle of exit, and we have, in this case, previous spots where we have arcs. So we have another way of triangulating. Now, the first thing I did when I checked this was I was like, well, wait a minute. So we should be able to then do the same thing here. Where is the diamond here? This is really obscure. It's really hard to see. But this is why it's really helpful in our case to have an understanding of sequencing and understand like what this is, what this is. This is a way for you to identify, right? And there's the rotation happening. This is a way for you to identify where that center is and where the end then should be. So then where should the end be? Well, if this is to this, right? So you have the bounce down, then you have the pullback, so you have the bounce down, then you have the pullback. Then what is this move, right? How should that occur? So on and so forth, blah, 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 blah. Basically, it's just taking you back to where does the diamond actually start? Where does the widening begin, right? And in this case, it stays pretty high, but you can see like that there's a widening here and then a slight narrowing, and it's not very easy to identify in this particular one. All right, it's just not. You definitely see a widening on the outset here, and we can talk about that in another video. The point is that if you were to look back here and you were to observe, like, well, that's where you see, and I might not get it right the first time, because it's right where that breakdown happens. That's where you see the breakdown, and then this is the structure. Then the exit of the structure would also be here. And we do find that that target matches. And then additionally, you can take it even to the top here, and it basically matches right to where we end up going, up to here. So how can I use this to determine where we go next? Like what makes the most sense here? Well, with all of this stuff combined, you basically can pretty easily get an idea of where the next up target is and where the next down target is, and you can have a confirmation model for that. So at this point, if you have a creek line, and we do, and I might have another line here let me get rid of, yeah, there's an extra one. If we have a creek line, and we have one, right? And it may not be the only one. You might have more than one here that you're going to have to deal with. Okay, it's not always as simple as the first thing you pick out. There's a couple different ones. Like that one doesn't look like it's even broken yet, right? But the narrowing is occurring. We can see the same structure that we just talked about. There's a widening, and then there's a narrowing. You see that? There's the widening, and then there's the narrowing. And it's a weird one, but it's all there. And if you look at something like the RSI, or if you look at the SPY right now, it's more apparent like where that is. You can see the widening occurring as it's coming down, and then it's starting to come out sideways and narrow on the bottom. So where would you then draw your conclusion from? Well, and here's where, I mean, where would you draw your, your rebound from? Here's where things get kind of tricky, right? Because at this point, it's usually from the breakdown. It's usually from the breakdown, not from the peak here. So I could go and I could look at this and say, well, I think it's that. That looks like the straight part where it drops down. I could take that and I could draw it back from where I think we're going to break out here on this. And I could say, yeah, it looks like it's lining up pretty well. I would agree with you there. If you said that, I'd say, yeah, it looks like it's lining up pretty well with a rebound to this point in time. And this 530 rate region coincides with a lot of the other targets that we've been getting recently, including like 480, 515, and 530. And all those targets are clusters in this region here that you would expect to see if you break out and come across the creek here, okay? So then what you can do is you can say, well, if I have a price target, hypothetically, right? If I have a price target and it's basically this estimated region up here, I need to then narrow in and make sure that I've got my arc correct. And I think I do. I think it's fairly accurate. The only other thing I can do then is look at the schematic and say, well, it should do something like this, where it rejects off, the top here, comes down and then breaks out and starts to the upside, and it should have a nice move to the upside. currently the way I've drawn it, it doesn't even look like it has that, but I can definitely like pull it in a little bit and you can see that, yeah. And I'm not saying you should do this willy-nilly. You should measure it and make sure you're doing it right. But you could see that, sure, that could be your downward motion that made a slightly lower low. And if not, then it hasn't happened yet. It may still come down. That would be your breakout, right? And potentially your move to the upside would occur shortly after that. In addition to that, when you combine that with a downward trajectory arc, you start seeing how all these pieces are suddenly like really fitting together in a really cohesive way, and it's good. You combine this with your downward trajectory arc, and you can see how, yep, that seems about right. You're coming into the intersection of not only where the gap fill is in this particular case. There's not always a gap there, right? There's just not. You're not only coming into that particular region, yeah, but you would be retesting potentially like the arc here. That's the last thing I should address here is the angle. So not only are they going to be kind of mirrored coming out, not only is this a full schematic coming down and you're going to have a breakout spring at the bottom, you should have a mirrored angle. And this part is kind of like an aha moment as well. When you get to the end here, this is a 67-degree incline in this particular case. So if I could do the opposite here, 67 degrees, right? Once again, it's like, well, where would that take you? It's a similar move at a similar angle that's opposite. And you can see that yesterday it was following that angle really well, like really well. And even more fascinating, let's zoom in for a minute. It didn't continue to follow that angle, I know. It kind of listed out to the side. But even more fascinating, it says 72 degrees right now. So I'm changing the size of my screen, is if you take that and you draw it backwards again over here, let's do a negative 72. May have done this wrong. Hang on just a second. That's the steepest angle, right? And it's the last known angle. You can see here it was the last angle that's used on the cross coming down here. If you take the wider berth, let's say you do 62 degrees. So let's take this out to 62. You come back up at the top and you look at where this was from top down, from this particular peak down, it's also 62 degrees. So by creating a symmetrical structure coming down, when they got to that middle point, they basically duplicated the same downward angle, right, on this gap and the reaction to it, and are now creating a symmetry here. So an entry and then an exit that takes you back to the correct level, and that also happens to match, right, the initial drop down level, which is what kickstarts this whole downward trend. Yeah. Pretty incredible. So again, my goal here is not to necessarily tell you exactly how to do this every time, but to show you that this structure exists so that as you're watching this and you're seeing how this thing is like capitulating, and it's a terminal action, right? That you have realistic expectations for what these bounces are doing. At this point in time, you might be asking the question, well, okay, let's say that I agree with all that. How then do you know like where it's going to go next if that's the case? Well, again, the best thing for you to do is to use the trends that are available to you. You know, if that's your creek line, then the next reactive move would be a pretty extreme move to the downside. That makes sense. It would have to be. You'd have to come back down and catch the creek, right, really low. And that's kind of where I've been at lately, is that I think that we are steepening. Yeah. And I think as we're kind of creating a steeper creek each time, that as we do these crosses, you're going to see the reaction. It's going to be there. It's not always going to necessarily hit the targets that you need it to hit or want it to hit. And that's why I have like the 480 as a possibility. And like I talked a little bit about the 430 a minute ago, because as this comes down, there's no guarantee it's going to have strength and get up here every time. Notice that what happened here is we didn't quite do the run with the SPY. Like it took a lot longer. And as a result, you're kind of left wondering, well, does that mean we just don't come back all the way? Are we only going to get to that 480 mark? And my answer is maybe, because ultimately, as they sort of waste time, and I don't want to say that in like a mean way, but as it's time is like being kind of sideways and all this other stuff, and there's no real moves happening, you're just kind of chewing it up. You're kind of absorbing a lot of the price action that could be occurring, right? And then you're left wondering, well, what now? Because if you've already crossed your creek here, where is that cross? Why has it not happened with strength? You know, and you have to sort of step back and look at it and say, well, you know, it is what it is. Okay, and then rinse, repeat. Anyways, I know it was long. I probably rambled way too much at the end. But this is essentially the schematic that we're looking at right now. It's pretty clean. And I hope that you guys learned something today. I know it was it's a lot. I know it's a lot to go over. Wanted to explain it to you so you could understand my reasoning for it. And I believe that it's going to be a very reliable way of getting price targets on these kind of downward motions in the future. That's all I got for you. I hope you have a good one. We'll talk to you later.